Welcome all to another great episode of Candid with CredAble, where we had promised interesting conversations with industry leaders, financial stalwarts, and fintech entrepreneurs. In the last episode, we heard the role of digitization from a customer's perspective and from a CFO's lens. Today is going to be very different, exciting, exciting and insightful. So, without further ado, let me introduce our guest for today, who frankly needs no introduction. We have a catalyst for change and promoting the ever evolving payment and digital trade landscape in India. Divyesh Dalal, currently Managing Director and India Head for Global Transaction Services at DBS, has worked across multiple leading multinational banks. In his role, he is responsible for cash, trade, and the custody franchise, and also leads the bank's digital initiatives across the spectrum. So whether it was commercializing the launch of UPI in 2016 or enabling real-time payments as a platform for truck drivers in 2020, Didi, and that's how we all know him, has been at the helm of transformation in transaction banking over the years. Divesh, very warm welcome to Candid with CredAble. Thank you so much for taking time out and doing this today.
Thanks a lot, Nirav. Thanks to you and your entire team. I hope I'm audible.
Yes, you are. Thank you.
Okay. Yeah. So first of all, a big thank you to you guys and your team for actually inviting me. And I think you guys are doing a phenomenal job in the market in these times, especially when suppliers and a lot of customers need help. So I think it's kudos to people like you guys that some of them are able to kind of get through these troubling times. So I think it's great, and thanks a lot. And I hope I'll be able to add a little value basis my
No,
experience in
absolutely.
that.
No doubt about that. Thank you for your kind words. Coming from you, that's a big endorsement and really, really appreciate it. So, Dee, let's talk about your journey. Through your career, you started. Why don't you tell us where you started? How did you get to DBS? And what's your favorite part of the job at DBS today?
Yeah, so I basically started way back in '97. That's when I basically started my job, or rather career with in banking. So I was with KPMG and I started auditing banks. Before that, I spent some good time in Tata Finance. So I think financial services is something that I knew probably a little better than anything else. So I thought might as well kind of get into it. So I spent 3 years with them across HSBC, Deutsche, and a couple of other banks also as well. So I did that for 3 years. Tried, very, very hard to get into trading, but unfortunately, didn't get the right opportunity. And then basically I called into City for 2 years, did audit out there. So and how can I learn more about banking? So I think 2 years in City. And then I basically decided that, before it's too late in life, let me just, take a jab at doing my MBA. So I went out there and did the MBA at ISB in 2002-3. So again, I never thought that after marriage I'll take such a big step, but I did. So kind of borrowed some money, and even in those times, I think ISB was like really expensive. So borrowed money, went and did my MBA, came back thinking that I'll get a better job, but yeah, back to square one again. So again, it was tough. Went back and worked in corporate finance at Citibank again. So I thought at least now somebody will look at me at a different lens, but unfortunately the lens never changed. So I guess I had to kind of stick it out, and I spent some time with a year and a half to two with the CFO in his office as corporate finance. So various initiatives that Citi ran that time, across their own legal vehicle expansion, etc. So I did that, and then 2004 is when I got into transaction banking in full scale. Did product for 6 years and sales for around 4 to 5 years. So I spent around a good amount of 14, 15 years out there. And then 14 is when I left Citi, went and ran the cash management business at HS. And April 19 is when I joined DBS out here running cash trade custody. So yeah, it's been a great ride. I mean, honestly, I can't complain. I'm always grateful to all my employers to take at least a call on me and letting me run some of the things that I have done. Uh, I don't think I would have expected most of them to kind of do that, but yeah, I mean they did, and in those times it was great. So I think some of the organizations and the risk appetite there, which is fabulous, I think, and the opportunity it gives you to know yourself better is much more than what people generally think. So a big thank you to all my employers and even folks who at City who took a call on me. My first boss, be Dinesh. Really grateful to him. I mean, I think those folks really taught me basics of banking and how product management is so important. And it's like I realize that consumer behavior is more important than anything in financial services, and that's the only subject I didn't take in B school. So I had that regret on finance does not mean no consumer behavior. So it's one of those tricky things you learn when you get on the field and speak to customers. So yeah, so that's been the journey. But at DBS, I think the best part of the job is we are a bank which is growing in India significantly. The acquisition of Lakshmi Vilas Bank, LBB, last November has been a big step in the direction of really going deeper into the country. I think that was most important for us. And post that, I've been traveling, to various parts of India, mostly south. Uh, the Tamil Nadu, Andhra, Telangana, all the textile clusters and all the manufacturing clusters in these 3-4 states. So it's been pretty interesting actually if you ask me. Although COVID has hit them, but I think the spirits are dampened at all, if you ask me. There is need for credit, and that's the best part of my job, that to understand how we can get credit across to folks who really need it more than anything else. And these are guys who kind of spend the midnight, to keep the lights on, right? And they don't have any backup. And I think if I can do anything out here to help these folks to kind of tide through in these times, it'll be great. And honestly, that's the only thing that I think of nowadays. Like, how can we help these folks to get through? Because I'm sure the big boys will manage themselves, but it's a smaller guy that gets killed in about the, and that's where I think folks like you make a very big difference, right? It's a good beginning, is what I would say for us and for folks like you in terms of getting into supply chains. There will be some noise, as always. There'll be some bad apples on the way. But I think it's a phenomenal opportunity, if you ask me, for the market, for the street, and for the MSME and SME, because they clearly need this more than anyone else in my view. Sorry, I think I just went along.
I mean, for a bank, a multinational bank, to start thinking about the SME, MSME sector and focus on that, that's pretty much unheard of. But then that's expected of someone like you, Didi. That being said, you have seen now 20 odd years of evolution of trade finance in India.
Mhm.
How do you think the landscape has changed from where you began to where it is today? And where do you see it going?
So I think, just a couple of things. I think earlier, probably, let's say 2 decades back when I started my career at Citi, I think it was largely, um, the large corporates which are looking at discounting and facility, right? I think they were first trying to get funds in early. So I think that was the first wave wherein the large corporates, started using the facilities. It gradually over the next 10 years to 2010, etc. I think the smaller ones have got to the party. But again, as all of us would have read, I think the rates are still not as low as they ought to have been because of credit reasons, etc. Rates will remain high, but it hasn't, kind of moved down to the smaller guys. I think what has happened now is that people have moved from viewing financing as a short-term credit facility to a transactional facility, and I think that's where the trick is. If you are or rather if a lender is able to identify the commercial transaction, whether current or in future, that's going to happen between the buyer and the seller. And basis that, if you can give financing to the manufacturer or the seller, manufacture goods, and then kind of obtain financing on the back of the history of his with a particular buyer, then I think that is a piece which in my view, will provide more information, more insight, more clarity, and that will help reduce the credit spreads which are there. So I think that is gradually started to come in. Obviously, there's a long way to go, right? I mean, given the way the MSMEs are in the country and the rates at which they are borrowing, I think there's a lot of scope out there. And secondly, again, I mean, most of the fintechs have turned up in the last couple of years, looked at, just managing or at least helping the MSMEs on the post-shipment side, which again is great, right? They didn't have to, or they don't no longer have to go to a bank branch and seek financing, because if you go to a tier two, tier three, they still go to a branch, right? So I think all the digitization effort, in my view, is going to help in a large way. And banks like ourselves and even companies like yourselves will really play a large role in my view, over the years to come. Because in 2, 3, and 4 cities, I think it's still more manual, and there is room. There's significant room for automation and digitization. So I think it's moved a lot. First is price discovery. Second is the way you transact, whether it's paper or digital. And third is how do you use history and data to actually go ahead and reduce the credit cost, right? And if that translates down to the ultimate borrow, which would be tier 2, 3, I think it's great.
No, sure, absolutely. And I think if you think about anchor down risk, which is very prevalent in most of the factoring and supply chain programs
Yeah.
that people stitch together, that creates a lot of inclusion, because with platforms such as tokenization, where you're able to do multi-tier financing across supply chains, and banks like DBS taking a forefront lead in partnering with fintechs to be able to do that, I think creates great opportunity for the entire supplier ecosystem, a dealer, distributor, retailer ecosystem, to get access to affordable capital. And I think, and probably you'd agree, that over the next 10 years, this would significantly penetrate down to the lowest common denominator, so to speak, of the supply chain ecosystem. That being said, I mean, everyone talks about technology, digitization these days. Well, we earn a living doing that. But that being said, how do you see a significant role of digitization and technology in banking today, and where do you see it evolving over the next, maybe 5 years?
So I think customers, again, basis my recent trips down, I've realized there's a distinct difference between the way the metros run, the state capitals run, in terms of the buying behavior of customers. And you look at tier 2, 3, 4, right? So if you look at metros and state capitals, um, given that the number of banks and financial institutions in these locations are significantly high, invariably people have a lot of choice, right? And therefore they're able to kind of go ahead and do more. Obviously, even the wallet opportunity in the metros and state capitals is significantly high. But if you go to tier 2, 3, 4, the guy actually does not have too much of, he doesn't have too much of choice. There are largely 3, 4 banks, and there are a couple of them which are digital, and there are a couple which are not. And given that there are a few banks, more often than not, the corporate, however small he maybe like 20 crore, 30 crore turnover, these corporates would typically bank, the corporate side and the retail side with the same bank. They wouldn't kind of split and go out so much. So I think both Bharat as well as India function very differently in terms of consumer behavior, right? So that's the first point. Second, therefore, there's an opportunity basis the market that you want to go to. So if you want to just go to the tier 2, 3, 4 markets, fantastic, right? You just need to digitize a little, probably add on a little more. Sorry. So you probably need to add on a little more in terms of your digital capabilities and the way they interact with you in terms of submitting a request, etc. And you'll be able to kind of get a large portion of the requests that you receive at the branch digitized significantly. But if you move to the state capitals and the metros, I think there's significant work that's required in terms of digitization. I believe that like the account aggregator piece that's kind of taken shape over the last couple of years. Um, I think being agnostic is going to be significantly important, right? As a corporate treasurer, I would love to interact with, a portal, or whether it's a bank managed or it's a fintech managed, which is agnostic to, uh, the institution that it represents, right? So if there is anything that can be agnostic, I think it's got phenomenal value because it gives the buyer of services the breadth to go and engage with any service provider, right? Otherwise, invariably, it's all bilat. And bilat, it has its own challenges with respect to price, with respect to engagement, etc. Right? So if there is anything, I think that's the most important piece that's going to hit out. And if you look at all ecosystems on the smartphone, etc., right? Although um, the Android as well as the iOS ecosystem is different, but fundamentally the way it works is that you have choice, right? So anything which gives you more choice is going to really run very fast, right? Compared to ones which don't give choice, right? And I think consumers, again, it will start from metro state capitals and will start trickling down to tier two, three, four. But again, as I said, tier two, three, four are very different in terms of landscape compared to the metros and state capitals. So I think agnostic is going to be, in my view, the single biggest differentiator between a service provider to corporates in the next 2 to 3 years.
Right. And speaking of which, I mean, you see, of course, a lot of fintechs providing a platform where you have multiple choices available to the consumer. What scope do you see of banks and fintechs working together, especially in areas of both payables and receivables financing?
Yeah, so look, I think banks and fintechs, in my view, ought to work together. I think two, three things. One is speed to market. I think fintechs clearly can do a couple of things far more in terms of the agile, the nimbleness, etc. I think they're far better than banks can be probably. Obviously, there are areas where integrations, etc., which are done with corporates, it won't make much of a difference. But typically, fintechs are a little quicker than most banks are. I think on receivables and payables financing, the beauty would be or the best solution would be that fintech, integrates with a corporate customer and then has the ability to engage with multiple service providers, i.e. banks or multiple providers of credit, basis which, in case if Bank X has credit appetite on, a borrower, then they can step in and up. So I thought that, in my view, would be the best way for receivables.
Right, but I would also think that fintechs may be able to scale programs far more
Yeah, of
efficiently
course.
in terms of
Yeah,
increasing depth, and I think that's really what the bank values, I would presume, because to be able to reach out to thousands of vendors or thousands of dealers and distributors digitally and then onboard them and then give them access
yeah,
to credit helps.
yeah, absolutely. So yeah, so you're right. Actually, it's I think it's in the way we look at it in DBS, it's no longer just the anchor. So we would look at it as, or other banks, in my view, would look at it as how many anchors you would get to the table, but how many spokes you would get, right? Because typically the multiplier would be, one anchor could we have an anchor with some 800 spokes, and there are some anchors which have even 50 spokes, right? So I think the beauty would be how many spokes does the fintech get to the table, because you want to lend to the spoke, right? The
Right.
spoke is where you could do much more, right? The anchor anyway is probably overbanked. I would want to believe that most anchors today anyway. I mean, outside of fintechs, they would have engaged with the bank, but they realize that the integration is really bad and they're not nimble, agile, etc. So they go to a fintech, they can do far more. And obviously, then you have multiple service providers that helps you get the price down anyway, right? So in my view, I think the spoke is a key piece of the puzzle. If
Sure.
you can fix the spoke, then I think you can lend more and you can make more money. So for example, I typically tell this to most of our customers that for one Dove soap that gets sold in the market today, if I finance it from Unilever side, the whole flow and the commercials are different. But if I finance the tier one, tier two, three suppliers, I think the commercials are very, very different, right?
Sure.
In fact, even the requirements are very, very different. So I think that is a key piece in my view.
No,
If he
absolutely.
can fix, yeah, if he can attack that and if he can address it, I think genuinely there's a lot of problem and value that we can add.
No, absolutely. And this also relates to the point you were making earlier about data being,
Yeah,
the greatest asset. So
absolutely.
because you're able to collect so much financial and transactional data on this
Yeah.
ecosystem, I think that helps lending to a great extent.
Yeah, and the other piece which I'd like to leave with you guys again is again think of tier 2, 3, 4. An MSME in tier 2, 3, 4 is not, it does not engage with a bank or a fintech for a transaction, right? They've engaged for they want to kind of deal with you for not one but multiple transactions and could be across their own, so could be payables, could be receivables financing, and even in terms of receivable financing, how can you help them kind of even procure better from various service providers, right? So I think the key is that, right, it's not about you just financing one invoice and getting away. The
Sure.
key is how you help them kind of even manufacture more and how you can help them even, get that better deal out there, which in my view today, if you see on some of the platforms that are available in the market, that's missing in a large way. So I think that's the biggest space, if you ask me. If you can get that, I think it's just, it's a gold mine out there in my view.
That's interesting. I mean, it's a thought that we at CredAble need to think about as well. So uh, no, that's a great idea, by the way. When you did you try to stitch together a supply chain program, especially with a fintech? How many teams are involved from the bank? Are there different constituent teams that need to come together to make us to have a successful launch for an SCF platform or an SCF product? That being said, do you see conflicts? Are there internal conflicts when you're working with a third party fintech versus directly working with a corporate?
Yeah, so yeah, so if you have to build a platform, I think there are two, three things, right? One is um, we all want to have the best, platform out in front of the customer, right? Um, but unfortunately, I think history would state that invariably what you think when you start off and what you finally land up in terms of delivery on, day one, your MVP and your final end state product, there'll be a huge difference between the two, right? And I think invariably, most of us, banks or fintechs, get lost in the process. The entire process, I think, just trying to oversimplify the journey, but knowing the customer, but trying to simplify the journey beyond the point, makes it very, very difficult. So I think the key aspect is, you define the journey, you get to the market, and then you improvise as you go along, right? And I think that piece on, launch and then improvise, launch, improvise, you keep on doing that. That is far better than, trying to have the ideal nirvana end state when you kind of launch, right? I mean, even the best movies launched by Pixar never started off the way they kind of wrote the script. Right? So fundamentally, I think that's the piece which most of us get stuck in. But it's for leaders like us, like you and me, to kind of step back and look at what is the bare minimum that we want to go with, and then take a hard call on whether the customer feedback is the other way or we indeed need to change the script. Right? So I think in my view is the biggest challenge, right? Your ability to step back and kind of look at, is this good to kind of go and hit the market, and can we improvise as we go along? Otherwise, in our desire to get it, spot on, can really kill on time. In my view, especially in financial services, I think that's clearly be an issue. But yeah, I mean, going just a little bit into what you mentioned, yeah, since we engage with multiple fintech partners and own tech service providers, internal tech service providers, there is obviously a challenge in terms of getting both to kind of speak. So I think that is one piece we have to keep on managing. Second is, I think, the balance between what we should build and what we should collaborate. I think that's the biggest piece, if you ask me. Invariably, again, our desire to kind of build out the entire monster ourselves, do we miss out on the opportunity in the market? And that's the question we have to keep on asking. And therefore, engage with fintechs, get to the market, and then see what's good. How much do we want to build and how much do we want to leverage is a decision that we keep on taking at all points in time. And it's with everyone that we engage with, right? And now, given the fact that each fintech in its own ecosystem. So there is logistics ecosystem, there's dairy ecosystem, and then there is pure play fintechs, on the financial side. All of them have now started looking at finance. So the dairy guys have also started looking at, oh, we've got data, can we finance? So the logistics guys also doing the same thing. So everyone has a different model, but they didn't build the baseline platform for finance, right? So even they got a tweak, and we've got to also kind of tweak the way we look at them and data. But again, as I said, uh, the balance is key to maintain what to collaborate and what to build out, and how much to collaborate with each one of them such that it doesn't become too binding, right? So if any one of us wants to kind of move away or type with somebody else, then there should be freedom. Because I clearly believe that if you give freedom to most people, then I think you can grow far better. If you start binding folks, then it becomes a little tough beyond the point.
Sure. So, and also I think from Anchor's perspective, right, large corporates have, if you try and every program is so unique, and the
Yeah,
requirements are so unique. So by the time you actually finish implementing one and you start the other, the whole demand set has completely moved. So it's
absolutely.
always challenging to keep up
Yeah,
with that, as a bank. And one of the reasons we exist is because banks, want to trust fintechs with like us to focus on the tech side and focus on all of that,
yeah,
while they can focus on core things like credit and this
that's
working
right.
capital. That being said, banks, of course, are highly regulated. Fintechs, on the other side, are not regulated at all. Or most of them, at least, are not regulated at all. So, do you see the government stepping in and the RBI stepping in and start regulating fintechs like China has done with, say, something like Ant Financial? Do you see that around the corner, or would you like to see that around the corner?
Um, so again, so I would like to put it this way that I think, leaving aside the way regulations are, I mean, uh, I'll touch upon that later. But the way I look at it is that if there's a corporate, buyer of services, right, an anchor corporate, and I think the biggest challenge they have in their mind is to engage with a fintech from a security perspective, right, data security. And I think whether the regulator says anything or whether the government says anything, I think the fintech has to deal with the challenge of how do I cross that mental block that the corporate has with respect to data security for the data that they will provide to us and will reside on our application, or whether the application resides on the server at the corporate end or at the server at your end or on the cloud, doesn't matter. The fact of the matter is that the corporate will always have that anxiety that data is sitting with a third party where they cannot go ahead and enforce anything, right? So if there's a fintech and if there are data security issues, will the anchor be able to go ahead and, kind of sue the fintech? They won't be able to get anything out of the fintech.
Sure.
So I think most fintechs have realized that it is in their interest to kind of ensure that at least their standards are as high as the banks have today, probably. Maybe they're not regulated, but I think more often than not, and I'm sure you guys also do the same thing, right? Because you don't
Sure.
want to blow out, because for you, reputation is more important than anything, right? And if you
Sure.
look at a substance or form, governments or regulators want to ensure that you don't have blowouts which impact the entire ecosystem, and you also want to ensure the same thing. So actually, both are working in the same direction. It's just that when there is a blowout, somebody needs to step in to say that you don't run away with information, or you don't run away with data, or you don't run away with even money sometimes. So actually, if you look at the whole guidelines, the DPSS ones for payment aggregators, the initial rollout, I think in 2008-9. Yeah, before that they were not even regulated, right? So Nodal didn't exist till 2008-9. It never existed. But then obviously RBI looked at it, and in terms of money which is third-party money, merchant money sitting in various investments which probably they thought was inappropriate. So that's why they stepped in. So I thought, I mean, those kind of things will happen. So again, it depends on how fintechs look at themselves and how they regulate themselves in terms of discipline at their end. And if that's maintained, I don't see any reason why there should be any overbearing regulation. But yeah, if there is abuse of power and space and freedom, I guess some of it may be kind of evaluated. Is the way I
And,
look at it.
and you've seen that happen recently, right? When all these loan aggregators, so to speak, without an NBFC license, and and they have created all sorts of problems for customers. And then the RBI was stepping in. So you see shades of regulation being
But
coming in.
correct, but see, that's what I'm saying, right? I mean, you have to always look at the interest of either the borrower, the lender, or the merchant in case of, let's say, payments, etc. Right? Now, if any of their interest is compromised because somebody, overstepped or overstretched the regulation, right, or stretched their boundaries because they're not regulated, you ought to, kind of expect some of it to come back and hit you, right? So in our desire to, or exuberance to just go ahead and kind of get more market share, if you do stuff which is crazy, then obviously it'll impact. And see, look, it's like this, right? I mean, there are X fintechs in the market today. Even if there are two or three which blow up, it's going to impact all of them, right?
Right.
So it's the weakest link in the chain that will impact the chain the most, in my view.
Right.
So I think it's in interest of everyone, banks, fintechs, everyone. Even banks will have a challenge. Right? So if there's a fintech that blows up, I think the regulation, if there's any in future, will impact the fintech and the banks, right? So it will be a challenge. It's on their own. So I think people ought to look at it a little more closely. That what is it that the regulator or the government is trying to do, and you will see it in the various ones. Whether you look at OPGSP, look at Nodal, recent PAPG guidelines, all of them, you can see the basis, right? And if you're crossing some of those, then yeah, I mean, you can't kind of blame the regulator.
Right. Didi, in today's day and age, if I don't ask this question, which I'm about to, viewers are going to kill me. So this has been the shortest gap, right, in between two large recessions. You had the crash of 2008, and then of course you've had COVID in 2020. Um, what have you seen, as a difference between both of these black swan events in terms of how has the landscape changed, especially for supply chain financing?
So look, I mean, I'll get into supply chain later, but I think 2008 and COVID, I mean, they are chalk and cheese in my view. Black Swan, I can understand, but this gets you more real and closer to life and people, I think, that matter more to you. Um, Honestly, I think you thank folks more now than probably in 2008 you would have, and you're grateful to things that have worked for you. To be honest, and I think this has been a watershed, in my view, significant change in the outlook of people. Um, and the way they look at business, the way they look at partnerships, collaboration. I just recently met a treasurer, and he had a personal exigence. I met him yesterday, and he had a personal exigence in the family, and he looks at the corporate very differently now than he did probably even a year back, right? And he said, compassion is something that I've seen for the first time, which is very different. So I think people are going to look at, employers, partnerships, all of that very, very differently, right? Everyone's out here, to kind of make money and be commercially driven. All that is fine, but at the end of the day, you value partnerships which stay with you for a long run, right? So I think that's the most important piece. Second is obviously from a payable financing. Sorry, from a payable financing perspective, vendor financing, I think there's a significant opportunity given that the market first, because of GDP shrinkage, the market is shrunk and therefore it's gone to a few folks have actually a larger share of the market now than they had earlier because COVID. So I think that has happened. But I think the big piece is that the smaller guys, again, need more help than ever before in terms of ensuring that they get paid early, they get paid not for post shipment, but they get paid to actually manufacture. And I think again, if I'm a supplier to, let's say, TBFRL and I'm a supplier to Page Industries, uh, today I think we only look at supply the anchor relationship, from a financing perspective. So I would look at Page and the relationship with off the spoke with Page. I would not look at, oh, he has five more relationships with different anchors and how can I kind of help him in all those five, right? So I think that's the piece that, in my view, has significantly opened up. Plus, they're more open now than probably in 2008 for sure, in terms of going digitally. uh, getting financing, and even sharing data. So I think they're far more open than they are before. I think even regulations, to be very honest, are far more enabling than they've ever been. I've always believed that I think RBI has done, Northern government has done way more than what any other regulator in the world has done in terms of being far more nimbler, being more customer friendly. Yeah, obviously it's a journey. All of us when we launch platforms, they're not on day one. So it's a journey and it kind of evolves. But I think they've been great. I mean, the support that they provided to the corporates as well as I think it's been fantastic.
And I
So
mean,
I think
COVID.
if 3, 4, you definitely find something. It's all about packing bags and getting down. Sorry.
Sorry, go ahead, Didi. I missed you a little bit there. Say that again.
No, that's it. No, that's fine. No. I'm just saying that yeah, you just need to pack your bags and get down to some of these tier 2, 3, 4 cities, and opportunity waiting. Yeah, that's it.
So we keep joking internally that COVID has been probably the best 10, 11, 12 months of our lives, because all of a sudden, anchors started deciding that they need to finance their vendors, and vendors, uh, started piling on cash, and that really transformed the way the
Yeah.
banking happens in this country. So, um, unfortunate event, but good outcome, I would think, for the SCF business. That being said, let's move on to talk about digitization. You've been at the forefront of digitization for several years now. Why don't we start by talking about DBS Rapid and the solution that you've stitched together for truck drivers? I think that's amazingly fascinating and very progressive for a bank. Would love to hear more about that, and then we can talk a little more about how you see digitization in the future.
Yeah. So look, I think it actually goes way back. I think the mid 2000 when that city and we said that if you're a merchant, the best thing you want is cash and carry. Right? You want somebody to give you cash across the counter, and then you would like to deliver the best form. There is no delinquency. It's beautiful. Experience is great, but it's cash, right? And then we thought of how can we move that to uh, the buyer space, right? When you get money electronically, and that's how virtual accounts etc. started off. And again, that initially started off in terms of data going to you a couple of times a day, and as soon as the merchant knows that he's got funds, so like Airtel would know they've got money from the prepaid distributor, and talk time is released. It's just beautiful, right? You don't need to wait for a couple of days for money to come in and then talk time being released. So I think that was the initial piece. Rapid, which is basically APIs, which we use for various customers in terms of providing data instantly. So again, out here we use APIs from a perspective of giving instant information on who's paid to our customers, so that goods can be dispatched. So that's your classic. You sell goods on cash basis, but you don't receive physical cash, but you receive it online, and you transfer the information within a minute or less, and then the whole ecosystem is beautifully oiled in terms of getting funds and then dispatching out. But that's more on the receipt side. But on the payment side, we realized that the biggest challenge that truck drivers have on the logistics ecosystem, two challenges. First is financing, right? Because the guy, when he starts the journey, he could travel anyway from like 3 days to like 2 weeks if he goes from Kanyakumari to like Guwahati. So that's challenge number one. In terms of he not getting paid for it, right? So he delivers goods, then he gets paid after the POD is received within 2 to 3 weeks. So that is a big challenge. And the third challenge is that he basically still needs money, right? Invariably, these guys need to going into the trucking company's office and withdrawing, taking cash or going into ATMs at some of these outlets next to the offices and kind of taking cash and then using it for fuel, nothing beyond that. So I think that's where we thought that there was an opportunity if the travel aggregator, in this case TCI, could actually go ahead and use our online platform to actually push funds out. So immediately, as soon as they got an order from an anchor customer like yourselves, let's say Unilever would place an order that wants to pick up 100 kits of dough from factory X and deliver it to the distributor. as soon as the order was transferred to PCI, they would actually, transfer. They would place the order with a couple of truckers, and then they would move money electronically using APIs to their respective bank accounts, and then on their way they would keep on withdrawing from a perspective of gas, etc. On the journey. So I think that's where they saw value. Otherwise, they were actually wasting at least half a day to a day sometimes to going into the office, withdrawing cash and going where they could start the journey immediately. So that's the value they saw. But again, we believe that the value out here will be significantly higher when we move back, in the ecosystem in terms of providing them financing on the receivables side, right? Because they would have a part of receivables on logistics. So that's the big piece which now we're trying to solve. So again, as you would recollect what I mentioned earlier, right? If we were stuck on this looking at, oh, we've actually helped them get money, we would have been there. But we said, no, let's figure out what are the challenges they have. And this is the bigger one that we've kind of, figured out. One of the good fintechs, a large fintechs in Bangalore. We've been working with them on the logistics space to see if we can actually solve this problem for a couple of trucking companies, because that's where I think they'll see real value. If we can provide them money when they start the journey and when they actually deliver the goods at that time. So again, great opportunity.
It's a phenomenal opportunity, and there is, it's just 80% of the money typically gets paid upfront
Yes.
by the aggregator or by the logistics company, and that's a huge working capital gap, because by the time we were pays them back, it's almost what,
Yes.
120 days. So that's probably and most trips don't fail. So from a risk standpoint, it's also very it's amazing. I mean, to see DBS do that and you handle that. This is more fintech than any fintech could be. So congratulations. I think that's a great.
I mean, I mean, thanks to you guys, and at least we didn't push to the corner to think differently. So as I said, it's a great partnership, whichever way you look at it.
So where do you see digitization take you next? What are the gaps that you see need to be filled?
So I think, so as I said, I think the first piece is if we can be agnostic, it's great. I think from a corporate buyer perspective, they would love to be engaged with the platform, which is more agnostic. So I think that's one piece which will always remain. The second one is multi-tier supply chain. I think that's the biggest piece in my view, where there is significant opportunity, because again, all of us are still stuck on the anchor buyer and the first level of supplier. I think we need to go down to tier 2, 3, 4. I think that's the other piece. And the entire ecosystem around logistics, warehousing, I think all of those, the entire support infrastructure which is sitting around it, I think that's the third piece which we want. Because all of those are working together, right? So unless until you have the warehouse, you don't have the goods. Unless you have the logistics company, you won't have the things moving. Then you have the trucking company, then you have the driver. So actually, if you see, and then once you have the driver, then you can do financing to the driver also, right? Because you have data, you know how much he gets money, how much he gets paid, and so you can actually provide driver financing also, right? Forget for the journey, but generally you can provide in financing. So there is a lot of opportunity in that entire space. So we believe if we can go down those, then there is significant value we can add. And all of those to Unilever actually, or let's say a big anchor corporate, would have significant value, right? If we can fix that. Because again, today, it's only the first leg which is not fixed or addressed, right? It's the subsequent ones, because the cost is actually hitting the anchor anyway, right? Because all of them are embedding the costs of actually financing in the overall cost that gets pushed up. So I think if we can do that, then we solve a big part of the problem.
No, absolutely, and you're right. I mean, the future of supply chain financing does look like tokenization and multi-tier financing.
Absolutely.
Look, that being said, I think we're close to the end. I just have one question for you before we wrap up. Look, you've been a progressive banker. You've been super successful at what you've been doing. What advice would you give, younger and aspiring bankers, if they want to lead the next wave of innovation and growth in this country?
So I think, couple of things. One which I believe is the non-negotiable. I mean, you got to have significant amount of passion I mean, if you're not passionate about things that you do, I think you should just drop it. It ain't working. Um, Second is don't get lost in processes. The goal is not the process, but the goal is the end product, which typically will not be right on day one. What you think as MVP on paper will not be MVP by the time you get it out, and probably will not be even the best product when you look back, say 10 years. That oh, is this what we envisaged when we sat in a Starbucks and kind of drew the blueprint? It won't be right. So don't kill yourself if you kind of if you kind of get lost. No, I didn't kind of fix it on day one. So I think it's fine. It's a journey. And I think invariably you get it right. In my view, you always get it right. It's just that, how much of fire you have within you to kind of hold it on. I don't think any one of us fails. You learn as you go along, and it's part of the journey. So I am a firm optimist of these things, right? So if you're passionate enough, you've got fire in your belly, you see it through. There's no way you fail. Absolutely no way. That's the way I look at it. Yeah.
Great, Didi. This has been super fun. Thank you so much for
Thanks a
taking
lot.
time out and doing this. Really
Thanks.
appreciate it. It's been a super insightful session, and congratulations once again on DBS Rapid and the solution you put together for the tracking industry. That's really commendable. And as a fintech, we are super excited to hear about that. Thanks so
Thank you
much.
for. Yeah, thanks, Nirav. Thanks a lot to you and your team. I think you guys as well as the industry have been challenging us, and it's great. It's always good to have partners who kind of challenge you to do more. And I wish you guys success and the entire industry also. And thanks a lot to
Thank you so much.
the entire team for putting this together. Thank you.